In this video, we will explore about assets-based valuation matrices. In the past, we looked at valuing a company based on what it earns, but today we are going to shift our focus to the balance sheet. We'll look at what the company actually owns to find its value. To understand this, we need to recall two key ratios. First is return on equity or ROE, which equals net profits divided by equity capital. The second is return on capital employed or ROCE, which equals EBIT divided by total capital employed. Remember that total capital employed is simply debt plus net worth. These ratios tell us the returns generated on the book values of the company. Now, let's look at the price to book value ratio. Unlike the PE ratio, which focuses on how much you invest to get a unit of profit, the price to book ratio focuses on how much you need to invest to own a piece of the company's assets. The formula is simple. It is market capitalization divided by the balance sheet value of equity. You can also calculate it as price per share divided by book value per share. Essentially, it measures the cost to get ownership rights for every unit of net assets. You might be wondering where this ratio is most useful. It is the preferred method for the financial sector. This is because banks and finance companies hold monetary assets, so their book value is very close to their fair market value. However, it is less ideal for capital intensive firms where old accounting methods distort value. It is also not great for service and technology sectors because their most valuable assets like human skills and intellectual property often do not appear on the balance sheet at all. Generally, a lower PB ratio is attractive, but companies with higher ROE can command a higher price. Let us try a real world example to see how this works. We have two finance companies, AFB Finance and LKH Finance. Both have a share capital of 500 lakhs. AFB has a total equity of 9,900 lakhs and trades at a price of 200 rupees. LKH has a total equity of 8,000 lakhs and trades at 175 rupees. We need to figure out which one is the more attractive buy. Step 1 is to calculate the book value per share. For AFB Finance, we take 9,900 and divide it by 50, which equals 198 rupees. For LKH Finance, we take 8,000 divided by 50, which equals 160 rupees. Step 2 is calculating the ratio. For AFB, 200 divided by 198 equals 1.01 times. For LKH, 175 divided by 160 equals 1.09 times. Since 1.01 is lower than 1.09, we conclude that AFB Finance is less expensive and more attractively valued. When you use this ratio, don't just look at one peer. The best practice is to compare a company's multiple with the average multiple for the entire industry. The rule of thumb is that a price to book ratio lower than the industry average means it is attractively valued. However, you must be careful. If an industry is fragmented, a few expensive outlier companies can pull the average or mean quite high. So, always check the median valuation as well to get a true picture. Let us move on to another important metric called the enterprise value to capital employed ratio. Enterprise value or EV represents the total value of the firm. The formula for EV is value of equity plus value of debt minus cash and cash equivalents. The ratio itself is calculated as enterprise value divided by capital employed. We use this ratio in combination with return on capital employed to decide if the return on our invested capital is good enough. Let us look at a scenario to see how this helps make investment decisions. Imagine a business with a net worth of 1 lakh rupees and debt of 1 lakh rupees. This means the capital employed is 1 lakh plus 1 lakh, which equals 2 lakhs. The market capitalization is 5 lakhs. So the enterprise value is 5 lakhs plus 1 lakh, which equals 6 lakhs. If we divide the enterprise value of 6 lakhs by the capital employed of 2 lakhs, we get a ratio of 3 times. Now, how do we interpret this? The business generates a return on capital employed of 45%. However, because you are paying 3 times the value of the capital employed, your actual return is lower. We calculate this by taking 45% and dividing it by 3, which equals 15%. This is your realized investor return. You then have to ask yourself, is 15% adequate? If you demanded a minimum return of 20%, you would not buy this. You would only pay a maximum multiple of 2.25 times to achieve your goal. Another approach used for specific industries is the net asset value or NAV approach. NAV equals the market value of assets minus liabilities. The key distinction here is that unlike book value, NAV uses the current market value of the assets. This method is used for businesses that are extremely asset oriented, such as real estate, shipping, and aviation, where the physical assets hold the real value. In addition to the general ratios, there are sector specific metrics you should know. For the life insurance business, analysts use price to embedded value. This measures the present value of expected future cash flows from policies that are currently active. It is critical for insurers, for non-banking financial companies or NBFCs. We use price to adjusted book value. This is the fair value of assets minus the fair value of liabilities, and it factors in items that might not be on the balance sheet. Finally, sometimes financial metrics do not reflect the potential value of a company, especially in special situations. For example, if you are valuing a dormant manufacturing plant, you might use EV to capacity, basing the value on its production capacity rather than its current earnings. Similarly, for a startup in e-commerce, traditional profits might not exist yet. In that case, we value them based on operating metrics like the number of users, the number of transactions, or the gross merchandise value.